Hey everybody, hope you're doing well. Wanted to record a quick video. Have Ashley, as always, joined here on our YouTube series. Federal Reserve raised rates by 50 basis points or 0.5%. Historic move, although it had been telegraphed for a couple weeks as they've hinted at this for a while. Ash, what do you think about what you're seeing in real time here?
Yeah, it's wild to see it in real time. I know everyone's curious about if they're going to keep raising it, if this is it, how many hikes there's actually going to be. But I think what's super important about us coming on here, and the question that I have for you, Brad, is just really how are these rising rates? And if rates do continue to keep rising, like how is that going to affect the bottom line for the consumer? And what are things that they should be looking out for?
Yeah, great question. I think you brought this up, which is great. Like one of the first videos we ever did was flagging the 10-year treasury above 1%. Historic rise. Actually, yields fell today, which means that the market is often a lot smarter than we give them credit to. Touch 3% on the 10-year. So a real massive rise over that period from 18 months ago. But also want to say 3% on the 10-year treasury. We've seen mortgages. We've talked about it before. We had Jody on the podcast to talk about it. 5% or higher on a conventional loan. So the consumer is already feeling the impact way ahead of this. So usually the market, as we said, prices this in to a certain extent. Where it really has an impact, where the Federal Reserve really has an impact, is going to be on variable rate debt. So we flagged this the last time Federal Reserve raised by 0.25%, but take a look at credit card rates that you're paying. A lot of folks don't even know the rate that they're paying. So that's going to go up even higher. Anyone that has a home equity line, there's usually the banks take one cycle to have it follow through into the statements there. So if you have a home equity line of credit tied to prime, going to be up by 0.5%, as we know, on the next cycle. So pay attention there. Not sure if you want to make an evaluation between making that a fixed rate home loan or depending on if you need a line of credit, doing that. We've talked about student loans for quite some time. So that's going to have some impact. Of course, federal student loans still on pause, but if you do have a variable rate student loan debt, something to think about. And then finally, cars, which have been in the news because the car market's just literally on fire. We will see car interest rates go up because those are usually tied to prime as well. One thing to hope for and consider is that savings rates, hopefully banks are going to trickle down some of this extra money to savers. We saw generationally low interest rates during COVID. 0% on those big banks that we saw, even the money center internet banks at 0.5, 0.6%. So hopefully we'll see savings rates increase. So be on the lookout for that. CD rates, if you're interested in CDs, those should be rising soon. So don't tie up the money yet until you see the impact there. And then a great blog that you've posted was kind of a primer on I-bonds. We saw the interest inflation I-bonds directly from the Treasury go up at this new cycle. So if you're looking at ways to save, those are some good examples. So it's both impacting the consumer on the saving side and then hurting the consumer on the variable rate debt side.
Right. Those are great points. I think if you take away anything, definitely now is the time to check to see what variable debt and interest rates you have. That's super important. Just see where you are and just so that you're prepared as rates continue to go up and there's no surprises later on.
Yeah, that's a great point. A lot of people were kind of lulled to sleep in this 18-month to 2-year period where rates were held artificially low. We're trying to make sure that you're aware of your payments are going to go up in some capacity. Forget the reason why we're raising rates is because of inflation. The Federal Reserve is trying to fight inflation. So not only will your budget go up on some of the things that you're buying, but if you do have any debt outstanding, now's the time to take a look at it, as you said. So if you have balances on credit cards, take advantage of potentially zero interest rate transfer offers and other things. Let us know how we can help you get your financial house in order. We're seeing a real shift in all of these things that are way different than the last 2 years. So that's a great point.
Great. Well, as always, let us know if you have any questions. Info at Sherman Wealth. We're here. We're happy to help. Like Brad said, get your financial house in order and let us know what you want us to talk about next week.
Thanks for watching.